The friction in the Middle East functions as a strategic bid for energy dominance, specifically designed to secure the massive power supplies required to lead the global AI race. Training and running large language models requires an immense, continuous supply of electricity. Control over global energy infrastructure dictates the input costs for AI competitors. Right now, U.S. domestic energy producers are capitalizing on the chaos, while Bitcoin is reacting to a quiet shift in institutional banking regulations. Fixating on the media's geopolitical fear narrative means missing the actual mechanics of where the capital is flowing right now. This map shows the Strait of Hormuz, the world's most critical energy choke point. 85% of the oil and gas passing through this narrow channel has a single destination: Asian markets, driving the economies of China, India, Japan, and South Korea. By exercising influence over this specific transit route, the United States gains direct leverage over the energy input costs of its primary technological rivals. Unlike Asia, the United States is a net exporter of energy. The domestic American economy is largely insulated from a supply shock in the Persian Gulf, while Asian tech sectors rely entirely on these vulnerable physical shipments. This creates a strict operational timeline. Major Asian importers hold roughly 20 days of natural gas and naphtha reserves. Naphtha is a liquid hydrocarbon mixture used as a raw material in the petrochemical industry. Once those 20 days run out, severe industrial rationing begins. That physical deadline puts a hard cap on how long the acute phase of this conflict can realistically last before global economic pushback becomes unmanageable. As global supply chains tighten, U.S. oil and utility companies are seeing a surge in cash flow. Domestic production is thriving as global prices push higher. These shielded domestic producers are funneling that new revenue directly into stock buyback programs, restricting the supply of their own shares to increase equity valuations. Secondary capital is flowing into the rehabilitation of deteriorated energy hubs, like the heavy crude infrastructure in Venezuela, to bring them back to full operational capacity. Rather than damaging the domestic economy, this localized disruption is acting as a direct stimulus for specific U.S. energy sectors. This chart shows Bitcoin's price action diverging from traditional safe havens. Despite a global contraction in financial liquidity, Bitcoin is currently outperforming both gold and the S&P 500. Bitcoin has formed a solid base above its 200-week moving average and is repeatedly testing the $74,000 resistance ceiling. This infographic contrasts the capital requirements for banks under Basel III rules. Basel III is an international regulatory framework designed to ensure banks maintain proper leverage to survive financial stress. Under current rules, holding safe assets like treasuries or gold requires zero reserve capital, while holding Bitcoin penalizes a bank with a heavy 100% capital requirement. U.S. banks are currently lobbying to remove this specific penalty. Dropping the capital requirement allows traditional banking balance sheets to flow directly into the asset. Because Bitcoin has a relatively tiny tradable physical float, the actual number of coins available for purchase, the highly leveraged paper derivatives market can easily push the spot price around on this news. The market is currently pricing in the inevitable standardization of Bitcoin as an institutional reserve asset. To navigate this environment, tune out the daily geopolitical headlines and focus on the physical flow of energy and shifting regulatory mechanics. Keep your eyes on three specific metrics: the 20-day Asian gas reserve clock, cash flow entering U.S. energy buybacks, and Basel III lobbying efforts. Sustained price action above $74,000 confirms the market has fully processed the impact of these energy and regulatory shifts.